What if everything you've been told about this bull market is a lie?
The internals of the market are weak. The AI bubble, in our humble opinion, has already burst. So we have two problems. We have a AI tech bubble bursting, so like the dot-com bubble, and then we have a housing crisis.
As the world gets swept up in AI euphoria and mega cap hype, Wall Street veteran Edward Dowd is seeing the cracks nobody is talking about. He's the former BlackRock portfolio manager who's made his name spotting market mispricings. And now he says we're staring down not just one, but two historic bursts.
AI spend is obscenely expensive.
Yes.
There's overinvestment. You know, $40,000 GPUs from NVIDIA are not sustainable.
Overinvestment, runaway valuations, and a Federal Reserve trapped by its own debt spiral.
The Fed is behind the eight ball. We think they're going to cut rates as the hard data comes in.
A generational Ponzi built on cheap money finally running out of road.
This debt-based fiat system inherently is a multi-generational Ponzi.
Yes.
It is. I mean, that's the math.
But if there's blood in the streets, where's the opportunity?
Bitcoin will probably bottom before everything else. So Bitcoin, I think, because Bitcoin tends to lead, I probably will buy everything when...
Is this the setup for the trade of a lifetime or just the end of easy money era? How do you survive and even thrive when the old playbook is burning? Well, ladies and gentlemen, stay tuned as Edward Dowd breaks down the real risks, the next shoe to drop, and exactly how he's positioning for maximum alpha when the dust settles. This is the interview Wall Street doesn't want you to see. Ladies and gentlemen, welcome Edward Dowd. So Ed, thanks for joining us. It's a pleasure to have you. How's it going today?
Great. Maui's always beautiful, so I'm having a good time. I'll go to the beach later. Thanks for having me on today, Kai. I appreciate it.
Yeah, very nice. I'm a big believer in quality of life. You know, I just moved back to the States from Thailand. A lot of people ask me why I lived there. I'll tell you, it wasn't for networking. It was quality of life. And now I just moved back to the States and made sure people, why didn't you move to DC or New York or Miami? And again, I think just for me, it's a quality of life thing. So I need to move and find somewhere that fits my lifestyle. It sounds like you've done the same.
Absolutely. Fitness and health and well-being are a big part of my life.
Cool. And I think that helps you be a more productive human being. But let's get into it. So you have called for a whole financial system reset, or essentially you guys put out a report also talking about a likelihood of a recession in 2025. You know, I think it was JP Morgan who had the recession odds at 65% fairly recently. I think within the last week, they've reduced that to 35%. How are you guys feeling about it?
Yeah, we're still thinking there's going to be a recession. And for your audience that may not be familiar with some of my calls, we made a call in 2023 that there was going to be a recession in the fourth quarter of 23 or first quarter of 2024. We were wrong. And we have these economic early cycle indicators that have worked for decades, and they unfortunately misfired. And so we had to ask ourselves a question: have the laws of economic fundamentals changed, or did we miss something? So we figured out what we were missing. There was an unprecedented event that happened in the history of the United States. And it's not really talked about because it's not politically expedient for the establishment to put a lot of focus on it. We let in 10 to 20 million illegal aliens, and they were brought in on purpose, logistically by the US government, washed through by the NGOs. And the stimulative effect on the economy was huge. Long term, it's not a great investment because a lot of these people are not productive. Only about 2 million of these illegal aliens found jobs by our estimate. And so a lot of that went directly into the economy. The whole economic all-in cost that affected economic growth was anywhere from $50,000 to $100,000 by our estimate per illegal. And that includes not only what they received directly in terms of government aid. It was the NGO system getting them from Central America through the Darien Gap, across the country, transportation into the interior, and all in. That's not a huge estimate. So that's anywhere from 500 billion to 1.5 trillion that stimulated the economy. So once we figured that out and we looked at Trump's policies, and government spending and deficit spending was a big part of what floated the economy the last 2 years, that's all going the wrong way. Trump has already stopped illegal crossings. They're down dramatically. And even without deportations, that's a big change. And a lot of people are self-deporting. And we're already starting to see that in some of the economic indicators. So we're calling, and there's also a housing crisis that is fomenting, that was actually pushed off a little bit by the illegal aliens coming into the country. Not so much that they were directly purchasing homes, but they were sopping up the rental market, which supported home prices. It's all going the wrong way. And the tariff news was a lot of gnashing of teeth, a lot of excitement, but it's what we call an endogenous event, meaning it was self-imposed. And we knew that Trump his main goal was to bring people to the table, and he did what we thought he would do. He removed tariffs, lowered them, and extended them out 90 days. And so we got a nice stock market rally, and I think the banks you were talking about, they were calling for recession when the tariff news was at its worst. Now they've reversed their opinion, and I think they're going to unfortunately be whipsawed both ways. This is what we're calling for is an endogenous issue. It's internal to the structure of the U.S. economy and the global economy. So this is going to kind of manifest and unfold over the summer into the fall. We've actually made we're working on an inflation report, and we're going to be putting that out in the next couple of weeks. And by our estimates, we see inflation at some point in the next 6 to 12 months printing a sub 2% CPI number.
Yeah. So
what we're seeing is a slowing of economic activity and inflation coming down, and then there'll be a deflationary scare. So the big takeaway from our report is basically lighten up on risk assets and move into cash or cash equivalents until the storm is at its nadir, when the headlines are the worst. Warren Buffett's been doing the same thing for 2 years. He was early like we were. I don't think he saw the illegal immigration as well, but he's waiting for significant risk assets to be on sale before he redeploys that cash. So that's where we are. We can get into the details of it, but bottom line, Trump's policies are reversing all the economic juice that the Biden administration put in. And we don't even need to see government spending go down that much or cut. You just need the rate of growth in the deficit to slow, and this will have a huge economic impact.
What is your timeline for this, do you think?
Well, my partner, Carlos Alegre, who I work with, he's a genius, PhD in physics and also finance. He's thinking the hard data starts turning south this month. I'm thinking the fall. So there's an internal debate. So, our call can either manifest quickly or take, the summer off and start to show up in the fall. It doesn't really matter. The stock market is trying to reach new all-time highs. It may hit new all-time highs, but the internals of the market are weak. The AI bubble, in our humble opinion, is already burst. So we have two problems. We have a AI tech bubble bursting, so like the Dotcom bubble, and then we have a housing crisis. So it's like 2007 and 8 combined with 1999, 2000. So it could be a deep, quick recession, and risk assets, I think, are not your safest bet once the markets start to figure this out.
Yeah, it sounds like Jerome Powell's position has been fairly clear that the markets are, in sound enough condition where he doesn't feel like an immediate need to reduce rates or, turn the money printer back on. But it does sound like they're looking for this kind of, for things to get a lot worse before they do turn those levers on. Do you think that what you're calling for would be that stimulus that starts to get the Fed back to, quantitative easing or some other name that they might call it, and rate reductions?
Yeah. So the thing to keep in mind is rate reductions into an economic slowdown are not bullish. They may be bullish for a couple trading days, but historically, if you looked at what happened in the dot-com bubble, they started cutting rates in 2000, And we didn't bottom until 2002 because there's a lag on monetary stimulus. It takes 12 to 18 months before it gets into the real economy. The same thing happened in the great financial crisis. They started cutting interest rates in '07 and kept cutting. So that I believe, and a lot of people believe, the Fed is behind the eight ball. And in our report, we talk about real interest rates still being too high, and slowly that's going to work its way into the credit markets where credit's going to tighten up. It already is. Auto loans are hard to get now. The consumer is hurting, that kind of thing. So we think they're going to cut rates as the hard data comes in, but the bottom in risk assets won't happen immediately, and then there'll be an event where they have to come in with the bazookas, and we'll make the call then what's going on. So look, there's going to be a deflationary scare. They're going to reinflate the system, and we'll see what that looks like. And of course, risk assets will take off, but unfortunately, we think risk assets take a nice haircut going into that low. And if I'm again, timing is always uncertain, but I would say that we could start to see a real problem, my personal opinion, in the markets in the fall, all risk assets. And then we get, hopefully it's quick and painful and fast. And we get a low sometime in the first quarter of 26, maybe the second quarter. And then the party starts again. Now, if this goes systemic, which we're not calling for, then we have other problems. But, that's why I'm optimistic and hopeful that we're going to get some bargains, and people who are young that don't own a home will get an opportunity to buy a home because prices will come down. And if you're don't have a lot of money, not super invested, you get an opportunity to pick up a lot of bargains. People fear recessions, but I view them as opportunities personally.
Well, I think that I talked about this previously with another guest, and that was I see firsthand right now, the housing market already, the word that they use where I'm shopping around here in Texas is, softening. And you see a lot of listings that have been on sale on the market for months or even some over a year, and they're just not selling or moving anymore. And so now these things are going up for lease. And it's really interesting when I think about a potential parlay that could be positioning here. And I think diversifying, this channel is mostly about crypto, and how the macro markets affect crypto, in particular Bitcoin, and then the riskier ones as well. But I do think that for a lot of people, including myself, getting a good opportunity to diversify into real estate is an interesting prospect. However, where we are in the current market, I think it doesn't make sense at all to buy real estate. Real estate's near all-time highs, and we have this potential flood of liquidity, whether it's sooner or post temporary recession and we get this V-shaped recovery. I guess my question would be, do you see the timeline lining up to where we could be in a very risk-on environment, quantitative easing, bull markets, both in stocks, crypto, et cetera, at the same time we have a pretty deep correction in housing?
I think they all will unfortunately go down at the same time, but housing is particularly interesting because it's 20% of the U.S. consumption, housing and housing-related activities. So that's what really drives recessions in the U.S. Manufacturing, whilst important, has been outsourced for the most part. So this will cause a lot of consternation and problems. And the housing market, once it goes into crisis mode, it'll be quick, and you have to act pretty fast. You'll have about a year to pick up a property. So I think there'll be a lot of opportunity. Even if the Fed comes in with guns blazing, it won't solve the problem immediately if there's a credit crisis in housing. And what we got going on right now are high prices where the reality is starting to creep in. So this is like what we call a second derivative change at the top. And you're sensing that in Texas. It's starting, but it's got a long way to go. So this is going to work its way through the system. And I think home prices, I'm not going to call it home. It's all regional, but some areas will see 30% clips to housing at some point, because what's going on is the average person can't buy a home. And how do we know that? New permits peaked in 2022 and have been going down. The illegal aliens helped float that because new permits are a leading indicator of soft housing activity. We also have new home sale inventory at near all-time highs. And that's also a leading indicator. So homes aren't clearing. The home building stocks, if you look at the home builder stocks, they peaked out in October, November of last year. They're not really participating in this rally. They're back to where they were on April 9th, and they are already in a downtrend. So these are the types of things we look at, and we see it's coming. There's really nothing that can stop it unless the Fed wanted to do something crazy right now, but they're not going to because they need the evidence first.
Yeah, I agree. So you had a front row seats at BlackRock, and you also understand quite well, I think, how that whole traditional financial world works. I have some questions about that, but one last question on the whole recession and risk assets. Where do you think Bitcoin is, specifically Bitcoin, in that risk asset bucket? We've seen it. It's been correlated to stocks before. It's had a high correlation to gold before. Gold is a safe haven asset. Stocks are usually risk assets, and then we've seen days where it just seems to be potentially uncoupling from either. What's your perspective there?
Oh, I look at longer term correlations, and Bitcoin is a risk asset historically, and it's very correlated to the NASDAQ. Having said that, could there be a decoupling? Sure. But I go by historic, relationships. So I suspect Bitcoin, along with a host of other things, will get hurt in a risk-off environment. It's not necessarily a bad thing. I think you guys all know that, and a lot of crypto enthusiasts never sell. So if you don't need the money, just hold. Bitcoin is a legitimate asset at this point. It's not going anywhere, and someday it may decouple from risk assets and be viewed as a safe haven, but that hasn't happened yet. But that's the thesis on Bitcoin long term, is that if the fiat system starts collapsing, it'll decouple.
So you used to manage billions of dollars through BlackRock, and I'm just curious, for you personally, how is your personal portfolio allocation set up? What into different assets?
Cash and gold at the moment. I miss Bitcoin. I might get into Bitcoin when it comes down again.
Yeah, not too late. And then, so real estate, you don't have
I'm divorced, and I'm a bachelor, and the house is with the wife.
Gotcha. Okay.
The ex-wife.
And would you be looking to allocate into real estate if this scenario comes?
If I had a lot of liquidity, I would be looking to do that. Absolutely. Especially on Maui. Maui, in the great financial crisis, went down quite a bit because there's a lot of people that buy second homes here and rent them out. And they need that rental income to cover their mortgages. So in a housing recession, Maui gets particularly hit, and there's a lot of bargains, I think, coming. So your experience at BlackRock, you got to see a lot of things, I think, behind the scenes. I'm curious, we have these big international players that are often known to influence different macro environments and geopolitical policy. The entities like BIS or IMF, Bank of International Settlement, or the International Monetary Fund, how actually, I would say, influential are they in shaping policy, fiscal and monetary policy in different strong economies? Because I'm less concerned about the weaker economies, but in the ones like the States, China, Russia, BRICS countries, things like that. Yeah, they obviously have an impact. The BIS is, the central bank of the central banks. The IMF is a, super international authority that makes its own decisions. Dustin has talked about the IMF and wanting to kind of reform that. But the number one influencer of global interest rates is the Federal Reserve, because we are the world reserve currency. So when you think about the global interest rate, the U.S. is it. And when the U.S. keeps money tight, it tends to have a problem globally. When they loosen, it tends to create a risk-on environment. We've had this interesting scenario where they tightened tremendously. We had a mini bear market in 22. And again, we were calling for a recession. What really sent the stock markets going up again in the US particularly was the AI bubble and the juicing of the economy with the illegal aliens. And that kind of extended the life of this stock bubble, which we think is in the process of bursting. So, we've never seen anything like this. We should have seen a recession. We didn't get one. Money's still too tight. And globally, I think it's really starting to hurt other countries. The UK is basically not growing. France isn't growing. Germany has been in recession despite their stock markets being at all-time highs. And so we've had this decoupling of real economies from stock markets. What will really send people into a tailspin is when the stock markets start to correct.
Back to what you were saying about the dollar. And I'm curious, before Trump came into office, we used to cover on this channel quite a bit, a lot of the developments with BRICS, and it was expanding so quickly. I think if I can remember correctly, at one point, there was over 100 countries that were applying and trying to become part of BRICS. We know that they were working on establishing a BRICS payment system that was backed by different hard assets, and they really didn't have the exact formula publicly available in what they were planning to do. But we do know that they were planning to use that to compete with the US dollar as a reserve currency. In the past 100 days, things have changed, and we've seen, Trump come out pretty publicly opinionated about folks who don't want to use a dollar and what that might mean for them on tariffs, on trade, etc. Additionally, we've seen things like stablecoin explosion, and that being an easier on-ramp for folks in countries where their fiat currency is much more volatile and losing purchasing power much quicker than any other country around the world. What are your thoughts on the dollar's position today? Does it still have a lot of hope? Is it inevitable that it will collapse? And what do you think comes after it, if it's going to collapse?
Yeah, so a lot of questions in there. Let's start with the BRICS. The BRICS were really enabled by the Biden administration because it was a weak administration.
Yes.
And what the Biden administration did really miffed our partners. They used the SWIFT system to sanction Russia, which had never really been done before. Then they threatened to steal Russia's assets, which is never. We didn't even do this during World War II. So this really got a lot of people together to talk about decoupling from the dollar. Having said that, it's a lot harder to do that in practice than theory, primarily because if someone wanted to get off the dollar system and start using a BRICS currency, so to speak, they would have a deflationary crash in their economy because most of the countries have issued lots of dollar-denominated bonds. Not only government dollar-denominated bonds, but private corporations have done the same thing. There's about 20 trillion, or no, like 15 trillion in this debt. So they're unfortunately inexplicably tied to the US dollar. And, there's also threats if you go off the dollar system, like military threats behind the scenes. If you want to understand what happened with Syria, Syria didn't have a debt-based central bank. Neither did Iraq. Neither did Libya. Neither does North Korea. So despite all the rhetoric around why we hate these people, it really comes down to that, in my humble opinion. Money and power.
I agree.
You can make up a bunch of nonsense about, we're promoting democracy. They're Hitler. They're whatever. That's why we went after these people, in my personal opinion. So there's military threats. They're too deeply tied. And a reserve currency historically doesn't die overnight. It dies with a whimper and takes time. The British pound sterling took 40 years to die, but it finally died and the US took over. I think we're definitely beyond the peak of dollar dominance in terms of the timing of all this, but it's going to take a long time for this to uncouple. Is there going to be the death of the fiat system? there'll be, it won't be said that there's a death, but there'll be a monetary reset, a new standard of linking it to something, whether it's gold and Bitcoin or Bitcoin and gold or just either one of those alone. There's something coming because this debt-based fiat system inherently is a multi-generational Ponzi.
Yes.
It just is. I mean, that's the math. And we're getting, the great financial crisis, the world's economy shifted after that. They solved that debt problem, which was a private banking system debt problem, and they took it onto the central bank's balance sheets, and governments spent boatloads of money and took over from the private economy. And we really had a government global-led economy where people close to the government have gotten rich and close to the printing press have gotten rich. And, this is why we're seeing what we're seeing, a middle class that's been stripped of its earnings power, lots of political crony capitalism. And that's just the nature of what happened in the great financial crisis. We transferred all that fraud debt onto the central bank balance sheets. The government started printing like no tomorrow. And that kind of floated this low growth economy for 14 years until they had to raise interest rates. So this is kind of this is the end of something. I don't know how it all plays out, but there's definitely a reason why national populism is rising. It's a direct result of central bank policy and government policy since the great financial crisis. And the rich have gotten richer, and the rest have been made poorer through inflation.
When you call for the inevitable recession followed by hopefully this rocket that boost risk assets, you already let us know that you think the AI bubble has popped. Do you think that the AI bubble might resurge? Let's say that there's a new breakthrough in AI and we have another subsequent ChatGPT moment. Maybe it's, artificial general intelligence or super intelligence launches within the next 6 to 12 months. These things could happen. So the first question is, do you think AI might have a resurgence? And then second question is that when you start betting on risk assets, which kind of risk assets are you betting on? And do you see any new emerging trends that maybe the public's not aware of or the viewers of this channel aren't aware of?
Well, look, at the bottom, you buy everything. It's really not that difficult. Everything will be on sale. The news flow will be at its worst. There'll be, fireside chats by different countries with their people, wringing of hands. I remember the great financial crisis. The low happened in March of 2009 when everyone was basically thinking they were going to nationalize the banks, and it was the end of capitalism as we know it. That was the time to buy everything.
Yeah.
And that's kind of the thing I'm waiting for. Right now, people are fat and happy and thinking everything's fine. That's actually when there's a lot of risk. And it's unfortunately psychologically people sell at lows and buy at highs. That's because it feels better to buy at highs than to buy at lows. And I remember during the great financial crisis, when you're in the financial services industry and there's a bear market, you have job risk. It doesn't matter who you are, you have job risk, so you're afraid. And I remember, with our colleagues, we're like, it's so bad, it can't get any worse, which we knew was going to be a second derivative change. You go from very bad to less bad. And we know, and that was, and we held our noses and we switched our portfolio from a bearish leaning to a bullish leaning. But, we were kind of, joking. I feel like throwing up in the trash can. So as much as, I'm a professional, emotionally, you have to control yourself. And most people can't do that. And they panic and fear. So, there's a lot of opportunity coming, and it's going to be quite interesting. I forgot the gist of the question. I went off on a rant.
That's okay. It was basically, which risk assets do you think are going to be interesting? And, with the AI bubble might have a resurgence.
Yeah, the AI bubble. Let me talk about that. So we had a Dotcom bubble, And what was some of the biggest beneficiaries of the dot? There were a lot of fraudulent internet companies with no revenues. They all went to zero. But what was really driving the dot-com bubble were the real companies like Cisco, Nortel, Lucent, Qualcomm, you name it. There were a whole host of companies that benefited from that CapEx spending.
Yeah.
And there were a whole host of companies that built fiber optic cable across the country. And a lot of those companies went to zero. But the beneficiaries were what we call the arms makers. And that bubble burst, and all that capital that was invested in these fiber optic cables were repriced for pennies on the dollar in bankruptcy sales. And then from those ashes, the real Internet 2.0 companies emerged. Facebook, Google, Amazon was the only one from the previous bubble that survived. You had a ton of, Apple was a beneficiary of cheap bandwidth. So what's going on now is AI spend is obscenely expensive.
Yes.
There's overinvestment. You know, $40,000 GPUs from NVIDIA are not sustainable. It's a semiconductor company. So I expect a lot of this investment to get wiped out, and then it'll be cheap computing. And then I'd be looking for the AI companies that emerge from the rubble. And sure, AI is not going away. When I say the bubble burst, I mean the stock paper bubble and the investment bubble. And the investment in the first quarter from data centers literally was off the charts. It looked like a peak investment cycle for AI, and second derivative is lower because currently there's no ROI on AI, the investment they've made in AI. There's no revenues on the other side to speak of. Same thing happened with the cheap bandwidth. That's why they all went to zero. There was an oversupply of bandwidth. They didn't get any customers, and then it was bought for pennies on the dollar. So this is the same type of thing. Bubbles are not a bad thing. We had a railroad bubble in the 1800s. All those initial investors went bankrupt, but then we had the railroads, you know, and then we generated a lot of economic activity over time from that. Same thing here. There'll be some beautiful gems that come out of the dust bowl of this rubble, but I don't know who they are yet. But that's what, when everybody hates AI, I'll be looking for AI stocks.
What, I mean, off the top of your head, can you think of any type of AI Gen 2 companies that one might want to look for that comes out of that?
Because I didn't know Facebook existed during the dot-com. Like I'm saying, look for people that create business models that take advantage of the overinvestment and repricing of computing power in AI. And and we don't know who they are yet. And maybe one of the ones that are currently public benefits, I don't know. But what I do know is NVIDIA is a semiconductor company. They benefited from a huge investment boom, and they're going to not benefit from the second derivative of that rolling over. And it's not a statement on NVIDIA as a company. People get confused between stock prices, and when I say the stock is going down, it doesn't mean I hate the company. It's just a piece of paper that's overvalued, and their fundamentals are going the wrong way.
So I know that you, what year did you get comfortable with Bitcoin and start allocating?
I haven't allocated yet. I feel like
you have. Oh, yeah, that's right. That's right. You said that. Okay.
Yeah, but look, I've admitted on many channels that I missed it. But I'm not one that bashes it. It's a legitimate asset, and I hope to get into it on the next risk off trade that I think is coming just for all risk assets. So I have no problem with Bitcoin. I wish I had been involved. So let's just say that.
I think that what you've said about the AI industry certainly is either happening right now in the crypto industry, or is still maybe yet to happen. You know, we've seen. I think mostly when we get into the kind of smart contract discussion, because I think at this point, Bitcoin is the immaculate conception that can never be redone. You know, it's. I think that's completely no competition for Bitcoin's space. Now, when we get into like programmable computing and smart contracts, I do think that we're probably seeing something similar to the whole MySpace, Facebook, Twitter evolution here, and that first generation of the attempt to maybe not, maybe be the second movers or the third movers potentially even that benefited from the innovation that happened early on. We see Ethereum being built and then trying to upgrade that infrastructure. It's like trying to, remodel a jet while it's midair full of passengers. It's a extremely difficult task to do. And in the interim, we've got a lot of really good technology that's deployed, that was initially in, Mark Zuckerberg's R&D camp. You've got these projects like Sui and Aptos. I'm not sure if you're familiar with them, but they were born out of R&D from, what Zuckerberg had done and spent $1 billion doing. And I think that we're also likely to see some sort of, we actually see it every 4-year cycle, and you see only the projects that are really building, have real business development, and to survive through these multi cycles. I mean, you almost see almost every project that a lot of them, 99% don't survive these bear markets. Are you looking beyond Bitcoin when you go into the crypto market, or is it you're going to dip your toes in with Bitcoin?
Well, you mentioned smart contracts. Are you bullish on them or bearish? What's your opinion?
So I think about them like efficiency, right? And I think about efficiency. I think efficiency, and usually there's this, saying like, capital goes, efficient, where, I don't know how to say it, but like where it's the most efficient, right? And when you have middlemen involved in things, they're value extractors, right? And so I think that when you think about it on the most simple level, now it's not as simple as this, but if someone were to rebuild Uber, for example, in a way where it was truly peer-to-peer, because essentially it is peer-to-peer right now. The only difference is you have a middleman taking 30% of those fees from the two parties. But I don't see why something like a decentralized Uber, which would eliminate that middleman, make the drive for the passenger from his house to the airport cheaper, while allowing the driver to make a little bit more, while still taking a small 1% to 2% cut to go back to people securing that network, for example. I don't know why something like that wouldn't be more ideal for the actual users involved, the drivers and passengers. Now, Uber as a company, one could argue, well, it's continuing to push. It's pushing into, it's different ride-sharing capabilities like automation, like drone travel in Dubai or whatever. Okay, sure. And that, as a centralized company who needs to continue on innovation, will probably maybe need to do that in order to stay relevant. If there were to be a really good decentralized alternative that allowed more value to stay between those peer-to-peer parties. So I think that there's potentially a room in the interim, and certainly for companies that need continued R&D and pushing the limits and continue to develop. But I don't see ride sharing. I mean, I guess you could say that ride sharing is potentially being disrupted at the moment by autonomous driving. So how much longer do we have Uber drivers? I don't know. And in a decentralized protocol, you wouldn't probably have the hardware to build these autonomous self-driving taxis, right? So it's an interesting dilemma here. But I guess, what are your thoughts on what I said about the efficiency and removing the middleman from the equation in applications?
I absolutely agree. And I'm working on a project with a friend in the gold space, moving gold, brokering gold, getting gold to people. It's very complex. Moving physical commodities is very complex. Smart contracts might have a place there. And we're talking to someone that's looking into that. Early days. We haven't committed yet, but I think anything that reduces, and the problem is the middleman is fighting this because that's how they generate a lot of their value, and a lot of people are unfortunately stuck in the old ways of doing business. But I think eventually smart contracts have a lot of potential for efficiency. So I'm with you on that. So I'm bullish smart contract solutions. It's early days, and it's a space that's interesting that may have a lot more meaning after this risk asset decoupling that we're going to see. But it's a space that I'm curious about. I'll just say that.
I think other good examples are things like anything that is seemingly peer-to-peer, right? Airbnb, VRBO, these kind of solutions. You know, I'm dealing, like I said before, house shopping in Austin, usually having two sides of representatives middlemaning the transaction, and that process is incredibly inefficient. Let me just speak to the owner, please. Oh no, they're paying us a very healthy commission to do this discussion on their behalf. Well, it's really painfully slow process having you guys involved in the middle. If we could save on the commission from the realtors, then maybe we can negotiate a better price for the house and you could still make as much money, for example. So a lot of really interesting examples of things that I think are low hanging fruits. Now, I think the barrier for adoption thus far, people will say, oh, well, people have tried that. It didn't work. But just like AI and just like the internet, the early days infrastructure had to be built. And when we use those things, they were once upon a time the early adopters, the geeks, the people who really couldn't wait to get their hands on it. They were okay with the time it took to learn how to use the systems. If you wanted to use AI, maybe you needed to learn how to use Python, right? And, it wasn't, and AI has been around for, 35, 40 years. And it wasn't until ChatGPT, 3.0 came along or whatever, that it had that aha moment where all of a sudden everyone was able to use it. 35, 40 years of an industry being around before it was finally ready for retail. And so for those people who say that we've had, hundreds of billions of dollars invested in the crypto industry and we haven't developed anything that's mainstream adopted yet, they need to understand that it's coming, in my opinion. And what needs to be done is just a lot of work through the UX. And, I think that there's definitely a place for slow and expensive infrastructure like Ethereum, like Bitcoin. It's when you're dealing with a lot of value. You want to make sure that your transaction is on a network that's battle tested, that it doesn't go down, and that it hasn't undergone vulnerabilities and exploits, for example. Now, if all I want to do is have $20 on an account so I can tip people on a social network, I have $50 in an account so I can play my favorite games on a blockchain, or whatever the small value transaction is that needs super high throughput, I care less about the security of that account. I care less about having to sign the transactions every time I want to tip somebody on a social network or I want to buy a skin in a game. Delegate that signing authorization to the protocol itself. Yes, it's more risky, it's less secure, it's less fully decentralized. But I think that these hybrids are being built, and in application-specific use cases will determine how likely it is to be adopted. And so I think that we're at the cusp of these things happening. I haven't really seen anything yet that has gotten a tremendous amount of traction, other than, for example, I'm a big investor in a game called Off the Grid, developed by a studio called Gunzilla. And what they've managed to do was take a AAA game, build it out. It's now in beta testing publicly, and they put it on traditional consoles like PlayStation, PC, Xbox, and people can play the game without even ever touching the blockchain side of things. But all the in-game currency, all the in-game assets, they're still syncing on their own custom blockchain in real time. And if a user ever wants to pull their item off of the game console, they go on to a PC, they sync their accounts and on the back end, and they have their assets in their own self-custody wallet at that point. And I think that's a really interesting kind of hybrid approach that allows, on-chain transparency about the monetary policy, the fiscal policy of some type of token economy, but still abstracts away the really complicated stuff from the end user.
Well, it's interesting. Look, where we are on the adoption curve, that's open to debate, and you're thinking we're on the cusp. And I might agree with you. I'm not sure yet, but what I learned from the Dotcom bust was there was a lot of different ways technology was sold in the late 90s. It was big CapEx. This is for corporations. Big CapEx spend, and it was a lot of money, capital invested. after the disaster in the .com space, there was a lot of cheap bandwidth. And then people realized that the budgets and wallets of corporations for tech were constrained. And due to that constraint, we started to see monthly subscription services like Salesforce.com. A lot of people took advantage of this. And I could see a similar type of situation where you get a deep recession, and then the need for these kinds of solutions, all of a sudden it's an aha moment because it is efficient. What's stopping it is lack of interest in it at the moment, because what they've been doing is working. But when profits go away and budgets are constrained, this will be adopted. I think that's the key to understand. So we need a recession. We need margin squeezes on corporations. And I tell you, tokenization and smart contracts will start to probably happen.
Yeah. I'll tell you another thing too, from a DeFi perspective, just a quick anecdotal story. I mean, for the past mostly decade, I've been, I don't want to say unbanked. That's a lie. I've had one bank account in the United States, even though I've lived offshore in Thailand for the past 8 years. I haven't really dealt with much of, I have had a credit card, 2 credit cards, but I hardly ever use them. I've always done everything. My company receives money in crypto. We pay out employees in crypto, and I stay mostly on crypto rails. I mean, almost the whole time. I'll tell you that I've also been using crypto, not for in DeFi, but not for what a lot of people do. I don't yield farm or try to do these complicated protocols where I'm putting capital to work efficiently like that so much. I guess in a way that I am though. I use Aave, for example. If you're not familiar with what it is, it's I can post collateral and take out a loan. And I after I actually did that to buy my I bought my villa in Thailand in December 2022. This was essentially the bottom of the crypto bull run. This is when FTX collapsed and Sam and all this stuff. And I really didn't want to spend, because I don't keep a lot of cash on the side. I keep my value most of my wealth in Bitcoin. I wanted to get to buy the house. I thought it was a perfect villa, but I didn't want to spend Bitcoin. So for the first time, I collateralized it. I took out a loan to buy the house, and looking back, that actually ended up working quite well. I didn't have to spend my Bitcoin. It's appreciated from 15,000 to 105,000 today, whatever. That was very efficient, and I can imagine going to the banks, and the whole process for loans are incredibly painful. They ask for a bunch of things, even shopping here. They're asking me for so much stuff, which is hard for me to produce. Like, show me proof of your income into bank accounts. Sorry, I can't do that. Like, my income hasn't been going to bank accounts, So I think another thing for adoption is people have to try these things out. I mean, the first time I used Aave and realized that I got my loan in 12 seconds was completely a paradigm shift for me. So I think it's just people willing to use them, play around with them. Not everything is that efficient and that easy, but I think these are good examples.
No, your story is excellent. I love the fact that you literally held on to your Bitcoin, got a loan against it, and then made money on the appreciation. That's how it's supposed to be done. That's good on you.
Thank you. One more question before we wrap up. So you believe a recession's coming. You have dry powder on the side. You haven't allocated. You're waiting for, just like Warren Buffett, for that golden opportunity. What price does Bitcoin get to where you're really like, that's it for you? You're allocating at that point.
Well, I can't predict the price, but Bitcoin will probably bottom before everything else. So Bitcoin, I think, because Bitcoin tends to lead. I've noticed, this is my personal opinion, Bitcoin started rallying tremendously before this most recent rally. Bitcoin was already moving before the stocks got going. I probably will buy everything when the headlines are the worst, and I won't get the bottom, and I can't tell you what price Bitcoin will be. I don't know. Technically it needs to hold a level. Probably, I haven't examined that yet on the charts, but I'm guessing there might be a scare. If I'm right, everything's going to implode, and it doesn't really matter at what price you buy. If it's down 50%, who cares?
Yeah,
it's down 40. You know what I mean? It's look, there'll be a period of time where there'll be bottoms are difficult, and you might lose money in the short term. But if you're looking out 3, 4, 5 years, who cares, right?
Right. Well, if you want my advice on that, typically in every bull run, and it sounds like you and I both agree that even if a recession does come, it'll probably be short-lived. It'll give the Fed and others the incentive that they need to turn back on the printer, reduce rates, and create a more favorable risk-on environment, which will send all markets much, much higher. So we agree on that. And I could say that if we do see, and we likely will see, another big correction in Bitcoin, almost every bull run, we see multiple corrections from wherever they start to correct from, down 30, 40%. We've seen that. We saw that from January 20th when Trump came in, from 108,000 all the way down to 76,000. Now we're back to 105. I wouldn't be surprised if we shoot back up in the interim, 120 and then come back down another 30, 40%. And so I think that's probably the range. It might, if we get one of these, if something happens that creates a black swan and that's what cracks the system, that leads into this recession, then we could get another 2021 COVID crisis where it comes back down 55%. I forget, maybe it was even more than that. But it was a super quick V-shaped recovery. I mean, it was down there for a day or two, but before it bounced back to that 30 or 40% level. Yeah,
no, if you get a halving in anything, that's always usually a good opportunity if you have a time horizon other than a couple. If you're not a day trader, you're going to be right eventually. You don't have to sweat it. You get it 50% in anything, and it's like a real asset. It's not a piece of crap stock. You're going to be fine.
Yeah. Ed, thank you so much for your time today. It was a pleasure talking to you. I learned a lot and enjoyed time in Maui and the beach.
Thank you, Kyle. Great to be here, and welcome back to the States.
Thank you, sir.